So in Chapter 6, Objective 4, oops, guess it would help if I switched over here. We're going to discuss the effects the costing methods have on the determination of income and taxes. So I think as we discussed the other day, we discussed that once a company chooses an inventory costing method, they pretty much have to stick with it. If they change, they have to basically validate their changes. And each method has advantages and disadvantages, and none of the different methods are perfect. Okay, there are pros and cons to each. They are affected by trends in pricing, if pricing is going up or pricing is going down. So you have to be thoughtful. Management has to be thoughtful about what method they're going to choose beforehand, because it is affected by trends in pricing. Sorry. It does affect the financial statements, as we kind of looked at a little bit the other day. It will have an impact on the financial statements, and therefore will affect income taxes. The Internal Revenue Service actually governs how inventories must be valued for tax purposes. And so, companies' management have to be on board and know how income tax, the IRS basically takes care of that and addresses it. In terms of a LIFO liquidation, the sales have reduce inventory levels below the level set in prior years in order to have a liquidation in effect. And it affects both the cash flows, because the choice of the accounting method is, basically it doesn't affect the cash flows from the standpoint that if you keep the same method from year to year, it won't have any effect on the cash flows other than the effects that the inventory changes would have normally. If you were to change the impact or change the costing method, then it would have an impact on cash flows, because you would have an adjustment or a write down or a change in your inventory valuation. Okay, so this is something you guys need to be familiar with. So we've talked about this before, the approach to how you factor in the cost of goods sold. And we talked about it in Chapter 5. We talked a little bit about it in the beginning of Chapter 6. So when you look at sales, you have sales minus your cost of goods sold gives you your gross margin. So if you remember, when we talked about in Chapter 5, you had to make sure you took into consideration how to calculate your cost of goods sold, which your cost of goods sold is your beginning inventory plus your net purchases, gives you your cost of goods available for sale, and then you back out the ending inventory. And that focuses you in on just what your actual cost of your goods sold are. Okay, you have to understand that mathematical equation, okay? And your test for Chapter 6 will take the information from the problems that we've been doing in class, and it will ask you to evaluate those changes and how it looks, or how to compare each of the different valuation methods, based on using the numbers from those different problems. Okay, so you want to be able to make sure you've got all your information correct from those problems, otherwise it will mess up your test for Chapter 6. Okay, and so you can see here that with the specific identification method, this one is the only one that really, actually is the true, if you will, cost of the inventory, because you're looking at exactly what the items are. But what do we say as it relates to the specific identification method? When do we use that? Only a few instances. When?
Cars, diamonds.
Right, cars, diamonds, things that say what? Fur coats, right. Things that you can very specifically identify in their individual items. Custom items, something that's custom, is going to be a specific identification method, okay? And then you have the average cost, and then the FIFO and LIFO. What do you notice about these last three? average cost, FIFO, and LIFO method. In terms of, what do you notice about the cost of goods sold, comparing those three? What do you notice? Anything? What do you notice about the numbers with the cost of goods sold for the average cost, FIFO, and LIFO? Nobody? Nobody notices anything? If you've done your numbers correctly, your average cost method should fall somewhere between your FIFO and your LIFO method. So that's what you can see here in these numbers. Okay? Okay, not sure why it's not clicking. Okay. So each of the four methods of inventory pricing is acceptable for use in the company's financial statements. And again, you'll see that there will be a footnote that will tell you specifically how your company is valuing its inventory. And then they must choose one method over the others after considering trends in pricing, the effects on the financial statements, and income taxes and management decisions. Can I go? Okay. No? Okay. Good? Okay. So in terms of looking at the effects on costing during inflationary periods or periods of rising prices, FIFO provides a higher income before taxes than LIFO does. Why is that? If you think about it, when we're saying that they provide a higher income before taxes, what's going to happen here? When we value our inventory and we value our cost of goods sold, when we have FIFO, we're saying that the first items in were the first items out, okay? So in our cost of goods sold, the oldest items have been sold first, okay? Typically speaking, during a period of rising prices, then those first items in our costing are going to be the cheapest priced items, right? So then our cost of goods sold is going to be the lowest, okay? So if our cost of goods sold is lower, then our gross profit is higher, and therefore our income is higher, and then our income taxes are going to be higher because our income is higher, okay? So cost of goods sold will be lowest under FIFO because it's based on the oldest prices. Under the average cost method produces income before taxes that is between LIFO and FIFO, just like the cost of goods sold is between LIFO and FIFO. And then during periods of deflation or declining prices, LIFO produces higher income taxes because it's the opposite, okay? Now, the higher prices during a deflationary period are going to be at the beginning, and the lower prices are going to be at the end. And you can see that comparison table on page 303 in your book. So, financial statement effects. In general, LIFO best follows the matching rule. Why do we say that? Because with LIFO, the last items in were the first items out, and so therefore the prices of the items that you're costing for sale are the most recently priced items, and is best for income tax or income statement purposes. Okay, it's a more conservative profit and lower taxable income, and so again, people like that. Conservatism principle, so that's more beneficial. In general, FIFO provides a more up-to-date ending inventory value and is better for the balance sheet. and we say this because generally speaking, inventory tends to lose value over time, and using the higher current cost to value your ending inventory gives a more realistic value or view of your assets. Okay, so continuing on here. Financial statement income tax effects. Inventory method chosen must be applied consistently. You can't keep changing it. Can't bounce around on it. If there is a change, it has to be for a good reason, and it should be noted in your financial statements. The IRS has a rule that if you use LIFO for tax purposes, it must also be used for financial statement purposes. Again, because it produces the lowest income before taxes. And using a Fifo and average cost methods in pricing, periods of rising prices may cause a business to report more than their true profit and therefore pay more in income taxes. In those later ones, if you think about it, the company could buy replacement inventory at higher prices than what is valued, and so therefore more might be needed to pay additional taxes. Okay, so your income tax effects. Oh, this one? Oh, sorry. Okay. Income tax effects. Businesses that use LIFO over a period of rising prices may find, for balance sheet purposes, the inventory valued at cost is far below what it currently pays for the same items. And so management must monitor this situation carefully. And if it lets the inventory quantity at year end fall below the beginning of the year level, the company will pay higher income taxes. This basically happens because the company would expense historical costs of inventory, which blow out the current costs of the inventory. And therefore, this is called a LIFO liquidation. So if we look at this chart, beginning and ending inventory are integral parts of the calculation of the cost of goods sold, and therefore have a very important impact on income before taxes. So if we look at our equation there on the left, net sales minus cost of goods sold equals gross profit minus our operating expenses equals our income before taxes. And then on the right, we're just kind of blowing out how do we calculate the cost of goods sold. And our cost of goods sold is going to be our beginning inventory plus net purchases. What do I mean by net purchases? We did that in Chapter 5.
Purchases minus allowances.
Good, very good. Purchases minus any returns and allowances, good, okay. And then we have any freight in costs, okay. If we have any costs of freight that we buy, any inventory that we buy, we have those freight in costs as well. And then we back out our ending inventory levels. So that's why that cost of goods sold, or that piece of the equation, is so important. How we value this has an impact in both the beginning and the ending inventory value, so it flows into more than one financial statement period. If ending inventory is understated, income will be understated because our cost of goods sold will be overstated. If ending inventory is overstated, income will be overstated because our cost of goods sold will be understated. It's understating that equation that we talked about last class. Okay, beginning inventory, our COGAS, our COGAS minus our ending inventory gives us our cost of goods sold. Well, our COGAS is the beginning of our COGAS is our inventory, our beginning inventory. The choice of inventory method will affect not only profitability but liquidity and cash flow as well. And Lipo generally produces lower income taxes and increases cash flow, and Fifo produces higher inventory value, which will show a better short-term liquidity position because your inventory is valued in your current assets, which affects your liquidity. Lastly, effects of misstatements in inventory. So if there's a misstatement, it will affect clearly our gross margin because if our inventory is misstated, then our cost of goods sold is going to be off. If our gross margin is off, it's going to affect our income taxes and our income levels. It will also affect the inventory for the next fiscal period. And it will also affect our stockholders' equity because whatever our net income is going to affect our, retention of earnings or profits. Okay. All right. So that's the end of section 4 in our notes. I'm going to pause my recording.